CGTN's Uche Okoronkwo examines the impact that the China-U.S. trade spat has had on the African continent. Let's now take a look.
There is a popular African adage that goes, when elephants fight, it is the grass that suffers. Now, though Africa was not the direct target of the U.S.-China trade war and has remained largely absent from the discourse, the reality is African nations are now facing a mixture of opportunity and harm to their economies. And here's why. Now, these trade tariffs have typically led to significant drops in commodity prices, local currencies, as well as major equity exchanges on the continent, but Africa could also feel that commodities export gap left by the U.S. in China itself. It also presents an opportunity for policymakers and stakeholders to redouble reform efforts and create an investment environment on the continent that will see Africa boost its position on the global supply chain. Still, most economic experts believe this trade war has done more harm than good to the continent. Last year, the African Development Bank warned that the trade conflict could result in a 2.5% drop in the GDP of resource-intensive African nations and a 1% fall for oil exporters in the next 2 years. That's because over 60% of Africa's exports go to the US, China and Europe, and more than 70% of Africa's imports originate from these countries. For example, the tariffs imposed on steel and aluminium by the US has directly affected South Africa's industry. In 2017, almost $400 million worth of aluminium and just below $1 billion worth of steel was exported from South Africa to the US. Now, this trade war has put nearly 8,000 jobs in the steel and aluminium sector at risk, and that's unless new markets are now found. Now, we can't also ignore that China has become the continent's leading trading partner. In 2018, China's total import and export volume with Africa was just over $200 billion US. That's a year-on-year increase of almost 20%. Today, China's loans to several African nations is in excess of $1 billion US. Now, when tariffs are imposed on Chinese-made products, Chinese production slows down, and that means growth in African nations which rely on China's need for resources for a chunk of their exports is now stifled, especially nations such as South Sudan, Gambia, Guinea and Zimbabwe, where more than 40% of their exports go to China. Also, as the trade war rages on, China's capital account surplus and its forex reserves will fall, and that could result in less aid and investment to Africa going forward. Now, there's been some debate as to whether African nations can benefit from the trade war and possibly fill some of those export gaps which are left by the US and China. Hefty tariffs on Chinese textiles could boost African textile manufacturers. Also, Chinese tariffs on U.S. agricultural products could open the door for outflows of value-add agricultural products, such as, of course, Kenyan avocados or Namibian beef. Now, critics are saying most African nations are not competitive nor have the capacity to replace U.S. and Chinese firms. For example, South African exporters of wine, fruits, or even nuts are a ready market, but their yield remains too low to satisfy global demand. Now, arguably, there is another upside to the scuffle between these two global giants. The two are now competing to strengthen their economic ties within Africa. FDI flows from both countries to Africa will be critical in creating jobs and, of course, speeding up the continent's industrial revolution.